saying good morning and welcome to the second hour of TheoTrade. I am Professor Jeffrey Bierman. I am broadcasting live from Chicago. For those of you who are wondering, it's about 60, 65 degrees outside. We'll be a high about 71. And today is Tuesday. It is August 26th. It's 2025. So let me say hello and salute the normal people. Hello, Ship. Welcome, Juan Santana. I see you regularly. Hello, Peter Schrader. It's come, Peter. It's going to come. Can't be there for longer. Hello, Rosario. Nice to see you. Where's Guatemala? Hello, Bart F. and John Fleck. John Fleck, a longtime person. Good morning, Ted. Good morning, Robro. Good morning, everybody. It's an interesting morning. My accounts are completely, two of my accounts are up, one's flat. Not much to say today. And we're just kind of grinding the gears here. So I'm going to kick this off and go through about 25 minutes talking about the market, maybe 30 minutes, and then we're going to switch gears to do a Genesis Cog spotting today. I do this once, twice a month at the most. I do run, there's the Trinity Trade, which is Gianni's franchise. There's Ghost Prince, which is Brandon's franchise. Each one of us has a franchise. Each one of us has a different theory, different methodology, different logic. Mine is all about lowest risk with the highest return. It's not about momentum. It's if you manage risk, you can become a millionaire. I've proven that. We will get to that in the second half. We're going to get to the market in the first half. So today's theme is not about a pun. I normally do puns because I got puns lined up for rotations and macro catalysts. Today's is obvious. It's straight out there. People, we're not going anywhere. We've basically hit the pause button. So we had that cocaine high on Friday when Powell said nothing and the market already made up its mind. They want to be bullish. You have the volatility constrained. It's like putting your foot on a coiled spring. You take it off, you get a 100-point gamma squeeze, and the day's over. You come in Monday, you've got that post-adrenaline rush. You've got a little bit of a hangover. The market backs off, pops a little bit, grinds, backs off 24 points, but we're still at the upper end of an all-time high range. We're in a vol box, but we're going to hit the pause button today. I woke up today, I looked at the market, and I said, we're going nowhere. We're going absolutely nowhere. It's very obvious to me, and if it isn't obvious to you, let me clue you in. The market ain't going down today. So if you're short today, I think you're screwed. I don't think the market's going up today very far either. I think it's going to waffle between probably minus 10 and plus 10, but it's obvious, people. For those of you out there, Secret Agent Charlie Buzz, good morning. Why is the market sitting here and twiddling its thumbs? Everybody, come on, tell me. We need a catalyst. Everybody, what's the catalyst? What's going to happen tomorrow afternoon? Okay, a nuclear bomb is going to hit the market. We're either going to make a new high or we're going to fall out of bed. Anybody? Yes. Tally Texas nailed it. We're on the pause button because it's all about NVIDIA. The market's not going to move. So if you're short today, if you shorted this morning, you screwed yourself. Okay, markets need to move on big catalysts. Sometimes it's liquidity, sometimes it's macro, sometimes it's micro. NVIDIA is the show. It's the showstopper. So the market woke up today, they hit the pause button and said, we're just going to grind and go sideways. The advanced decline is completely useless. It's just about sources and uses of cash. So if you're trading the market today, here's my advice. Follow Corey Rosenblum, follow Tony Rago, just trade the swings. We're not going to go up 30. That's not going to happen. We're not going to fall 30. We're pretty much going to stay range bound in a vol box in the market unless some people say, oh my goodness, let me get the jump on NVIDIA and let's start to sell off because they think that NVIDIA is going to deliver great numbers, which they are, and they're going to offer tepid guidance, or they're going to deliver great numbers and offer rosy guidance. You play that game. I don't want to step in there. I want nothing to do with it. I'll stick with mine. So it's hit the pause button today. Now, as far as macro catalysts are concerned, there's three things that have really caught my attention today, so let me walk you through these. I come in here every day, and my job is to get you ahead of the curve. If your house burns down and I show up as the claims adjuster and said, you should have bought a fire alarm, you're going to turn around, slug me in the face, and knock all my teeth out. I'm master of the obvious. I'm insulting you. You already know the news, so what is the hell of pointing it out? That's 90% of Wall Street. The market's down. Let me tell you why. It's too late. I don't care why. It's the damage is already done. Somebody already knew ahead of time. So I'm going to lay three things in your lap. You take it. You run with it. I'm not going to try to colorize it. I'm not going to try to agendize it or skew it. But again, these are headlines that are catching my attention. They're making me get a little bit squeamish, cautious, more defensive every day. Borrowed time. You all know what borrowed time is. Okay. News came out. 3 different social media sites. Cars are so expensive. This is what they're so expensive that buyers need 7-year loans. Now, my last car payment for my SUV, okay, I got a Mercedes SUV, is next month. My last one. It was a 7-year deal. I signed up for 7 years, long time ago. I take it as a write-off. I prepay all the maintenance at the beginning of the year. It's all built into it. Okay. Next month, no payment. I'm 100% owner of the car. It'll be basically 7 years, and I'm going to get rid of it in 3, trade up for another one. But here's what I want to say. Okay. Cars are so expensive that buyers need 7 years. There's a sign. If you're not paying attention to this, you're just being deluded. You're just turning a deaf ear, and you're just acting absolutely imprudent and ridiculously stupid. Okay, you have to understand, the average person is not people at Theo. The average person is a hand-to-mouth person who's just trying to get by, to pay the rent, pay the health insurance, put food on the table. That's the average American. When people are out there trying to upgrade to new cars, they normally make a down payment, and they're like, hey, let's do a lease, let's do a loan. And that normal loan, on average, is about 5 years. 6 is a push. Well, now they're extending it to 7. That's how expensive cars are. So when I hear this BS garbage on TV that, well, you know, the inflation rate's coming down. What the hell numbers are you using? You're just faking it. You're just making it up. Nothing's coming down. Nothing in Chicago ever comes down. Even the cost of parking meters are going up. Parking meters are going up. Everything here is expensive. The only thing that is not expensive here, one thing, you can buy pizza. That's gone up. That's doubled. Everything. Only one thing's not expensive. Public transportation. That's it in Chicago. I live in the epicenter of America, where we're the 3rd largest city. Don't you tell me that we have disinflation or in deflation. We don't. So if people are going out and need 7-year loans, it tells me people are thin on cash. They cannot afford. This is what I call an inflationary sign. I listen to Garrett every morning. I absorb him like a sponge. He posted a little bit on LinkedIn today about the 30-year and the 10-year treasury. We're at a crossroads point where if we take out the 5 handle, we're going to get stagflation. That's Garrett's premise. I'm not trying to bite on it to agendize it. I'm just telling you. All I can tell you is what I see and what I know. This is what I know. The inflation problem is out there. It's not coming down. There might be disinflation where the rate of inflation is slowing down, but that doesn't mean the prices are coming down. That's deflation. We need deflation, okay, in order for the Fed to cut rates. We're not getting it. So if you think there's 100% probability that they're going to cut rates next month, I would dial that down to about 50%, even lower than that, because this tells me inflation is still a problem. The prices of cars are not coming down. The second one, I call it Austin Powers. Now, this is a pun. There is clearly a pun here, so I'm going to walk you through the pun. There are 12 Federal Reserve governors. There's one Federal Reserve chairman. His name is Jerome J. Powell. He's a dunderhead. He's a moron. I don't care if he worked in private equity, Don. The guy is being there. He's Chauncey the gardener. He's a friggin' moron, okay? He has no idea. He completely makes up things as he goes along. He keeps changing the rules because he doesn't have any rules. Austin is the first name of Goolsbee. So if you go look up the Fed governor from Chicago Fed governor, who was a former University of Chicago professor, economist, it's Austin Goolsbee. That's the pun, as in Austin Powers, as in Michael Myers, Austin Powers. Austin Goolsbee did an interview with Bloomberg, and he said, I'm concerned about inflation. This isn't Jeff Bierman. This is one of the 12 supposedly smartest economists in the country who basically controls all of Chicago and the Federal Reserve Bank, Austin Goolsbee, he's telling you he's worried about inflation. Put aside Lisa Cook because she's a dissenting vote. They want her out of there. This is a systematic purging or draining the swamp so they can force the hand of the next Fed governor to cut. Not so fast. Goolsbee's telling you inflation's still a problem, and the borrow time headline, inflation's a problem. So even if we get a rate cut, the market could still tank because if there's three things that drive markets lower, it's falling profits, okay, rising inflation, okay, and what we call deleveraging the psychological buildup of margin. Those are the three things that wreck a market. And right now, the number one driver of this market is psychology. Every dip is being bought by every retail person because they think it's a funny, haha, video game joke. One day, it won't be such a joke. It's going to correct at some point. My suspicion is it'll be 1,000 points, which will be 20%. And a lot of people are going to get very badly hurt. And when you look for a reason, you won't need to find the reason. I already gave you the reason. Inflation is not coming down. Prices are going up. We're likely going to have slower growth, as Garrett tells you. We're likely going to hit a stagflation bump somewhere in the next year. The last macro catalyst I call paper late. It's an ode to Phil Collins and Genesis because I'm an absolute music nut. In musical Jeopardy at the University of California, Berkeley, I was the champion. I was always at these trivia contests. Is like my thing. I'm like an idiot savant who has a million facts in my head that are worthless, but they're good for winning, like, contests. Paper Late's a song off a Genesis album that came years ago. Phil Collins, Tony Banks, Mike Rutherford. U.S. consumers with the highest credit scores are starting to fall behind in repayments. Okay, I want you to hear this clearly, what I just said. The credit quality of the highest, most creditworthy paying consumers in America are slipping. They are going down. So just be aware of that. They have said time and again that even if the lower caste or the middle class don't pay their payments, it's okay. We're talking about people with the Amex Black Card that are late and falling behind payments. They reported that the credit scores of the highest grossing income people in America hit their lowest repayment percentage in 20 years. It has been since 2024 since people have had credit problems like this. And that came right after the dot-com burst. So I've got you three reasons for you to tell you, don't sell everything. Don't declare we're not going to crash. We're not. But get yourself prepared for some type of corrective move. It could be triggered by NVIDIA. It could be triggered by Apple. It could be triggered by anything. Don't look for the trigger. You're not going to find it until after we're down 1,000 points. You already have the triggers in front of you. They just haven't acted on them just yet. The market is in what we call denial. It's in like tunnel vision. It doesn't want to hear anything. It thinks it's invulnerable because it's being defended by algos. Algos don't react to fundamental news. Money managers do. You have three reasons to be defensive in this market. Now, as far as rotations are concerned, there is opportunity long and short in this market. The first one is Garrett Baldwin is a massive fan of Domino's Pizza. And Garrett will tell you over and over again, Domino's Pizza is not a pizza company. He's telling you it's like a real estate analytics, data analytics company, which it is. So is Amazon. Amazon doesn't sell shoes, people, like Zappos. That's crap. Amazon is a data analytics company. That's the bulk of how they make money. But yesterday news came out that Papa John's International, and of course, John Natter, who was ousted because he made some really sexist, racial, discriminatory comments, they got rid of him. The chair of the board basically is Shaquille O'Neal. Shaquille O'Neal is the largest, or if not the second largest shareholder of Papa John's Pizza. It's a difficult stock to trade because it's extremely thinly traded at 32 million shares. Like if you said do the options, I'd say you're out of your friggin' mind. Don't do the options. What are you doing? Okay, the spreads are too wide for you to even dabble there. But if you're interested in knowing this, okay, Domino's Pizza is going to open up 650 retail operation outlets in India. It's an untapped market. The US market is completely saturated. But once again, I give them credit. They're looking to go international. It's affordable. Everybody loves pizza. Be aware of this, that Papa John's International is going to me, this is not a reason to short the stock. I will not short this stock for that reason. In other words, they are not at a point of saturation. If they're at saturation point, which is what happened to eventually to what seemed at Lulu at 500, it's happened to eventually to Ulta. Okay, it happens to every business. They're going to get saturated, even AI. This is an opportunity where if the stock backs off, I'm not going to buy it here. I'm not going to buy it. Genesis Cog doesn't buy after a run. We buy on the breakout, so we would have bought at 43. But this is telling you, this tells me, not a good short, but for the longer term or a trade, if it swings back down, I will investigate a long trade here because they're opening up more stores. That, to me, puts pressure on Domino's Pizza, who's now going to do what? Look how Domino's Pizza's down, okay? The average American doesn't want to pay more than $10 for a meal. It came reported. And so Domino's Pizza is going to have to lower their prices even lower, and that's why the stock's down. But Papa John's is going to try to beat Domino's to India. I think it's a good move. I think longer term there's opportunity here. Next one is what I call the chosen one between IB, KR, and Hood. Okay, this has been out there for months. This is not like, this is just came out. But the fact of the matter is, okay, if you stepped in this morning and you bought this stock because of the news, and people are like, well, what was the news? Okay, the news is simply this. Interactive Brokers is being added to the S&P 500. So if you're asking yourself, why did Interactive Brokers rally all that much? It has very little to do with earnings. Don said this, and I'll give Kaufman due credit. I wanted to short this at the 55 level, and Kaufman talked me out of it. He's like, you can't short this stock. I go, why? He said, because they're a takeover candidate, or they're going to be added to the S&P. Don nailed it. He got it right. Well, now they're added to the S&P, but that doesn't change the value of the company. It doesn't. Being added to the S&P is what's called a market event, but it's not an economic event. It doesn't impact their earnings at all. It has no impact. So if you stepped in here this morning and you got news, oh my God, Interactive Brokers was added to the S&P 500, and you traded up here this morning, I would have fired you. By the time you got to your desk, your security card wouldn't work anymore. You log into your computer and your password and your username have been washed from my system. Don't you ever tell me you ever buy on adding to the S&P. I would fire you. I'd lose it over you. I'd scream at you and throw you out of the building. It doesn't change the value of the company. Now the stock is down. It's down $5, people. How moronic is that trade? It doesn't change the value of the company. It means a bunch of institutions, a bunch of indices have to go out and buy it. Whoop-dee-dee. After they buy it, you can short the crap out of it. It's basically a structural market event. It's not an economic event. And if you're ever going to learn from the Genesis Cog, the most important thing is numbers never lie. People do all the time. Your eyes deceive you. Numbers never lie. They always tell the story. And the story is that this is an overpriced stock. It's a over-gloated company. I'd much rather own Robinhood, Schwab, or Morgan Stanley than this company. In fact, I got rid of all my accounts here finally and moved them away. But I can tell you this, okay? If you think this stock is cheap at 33 times earnings, I would fire you. You're out of your mind. This is a bubble, people. And for people to buy this just because they were added to the S&P, that's not a reason to buy. You got to find me you can't wait around on the market for months at a time telling me, Professor Bierman, the only reason why I'm going to buy this stock is because I'm going to hunt and peck things are going to be added to the S&P. You'll be looking forever. Everything's going to be added to the S&P eventually, what it seems. Don't do that. On the flip side of that, Hood is going down. No, it's not. The fact that they weren't added means nothing. Hood is on the up and up. They're actually growing. So I won't short this. One, because they're a takeover candidate. but more or less, they're a much better company than Interactive Brokers is. And just because they weren't added to the S&P doesn't mean they won't be added in the future. But even if they are, don't buy it. It's going to gap up 9. You're going to buy it. It's going to back off, and you're going to get a margin call. You're going to be suckered and roped and carped to death. Buyouts and add it to the S&P, which is called reconstitution, and stock splits are useless. They don't do anything to the value of the company. It has nothing to do with the internal operations. Don't get suckered in there. Don't. I'm doing you a favor. Musky scent. Okay, so Elon Musk is on the prowl, and you can smell the scent already. So let me bring this to you front and center. So Elon Musk obviously is at odds with Apple. Elon Musk, meaning he's using not SpaceX, he's using his investment in Twitter, and he's going back to back with OpenAI. So he's basically reaching out to Sam Altman, and the two of them are getting together to file a class action lawsuit against Apple. For what? For basically like taking out source code and doing things that are what are called anti-competitive. So they're going to sue Apple for anti-competitive. Okay, what do I think? I don't think. I think in the long run, it's just a waste of time. I think the only person who people come out ahead will be the lawyers here. So if you sold Apple today, because Apple was down earlier in the day, it was down $2. If you sold Apple down here because of that, okay, I would fire you. Don't react to legal news. Don't. Legal news on Apple is like it's like a fly at a picnic. You can flick it away and it'll disappear. That lawsuit is probably frivolous, and no matter how much energy is going to be poured into it, most professional money managers are going to plug their ears and ignore it. I'm not saying to ignore it, but don't believe for a second that Elon Musk is going to take down Apple. You and I know that's nonsense. Apple is an 800-pound gorilla, and you can't tackle an 800-pound gorilla by hitting it with a wiffle ball bat. You can forget about that. So that news is interesting, but ultimately to me, it's like white noise. The last thing I want to throw out today of stories that kind of like hold my attention, that may be a tradable moment, might be a tradable moment, is this one. Derailed. So this is going to my point because Don discussed this earlier. So I don't want to beat a dead horse. Take a look at this stock. Okay, you know what the news is. Warren Buffett, they had a committee meeting up at Berkshire Hathaway, and they collectively decided that they did not want to add any railroads. They don't want Union Pacific, which is UNP, Kansas City Southern. Okay, there was all kinds of rumors spread on social media sites, which I told you are harmful. You can't listen to these people. They have a friggin' agenda, and their agenda is to burn you and take your money. That's their agenda. I was dealing with news all the way through this. I bought this down here, and I sold it up here before earnings. So I got $5 out of it. I walked away. They delivered numbers, and the stock ran higher. Fine. All I kept hearing here was somebody's going to buy a CSX out. Somebody's going to merge. It's planted out there. Then there was a rumor that Berkshire Hathaway was going to take a position in CSX. Berkshire quashed that. Buffett comes out, says, not only are we not interested in CSX, but we're not interested in any other railroad at this time. There's 3 things to take from this. Never trust the news media. 90% of the time, they're just trying to fill air. As Don said, they're trying to colorize situations where there is no color, or they're agendized because they're on one side of the trade and getting you to push it up. And as Garrett tells you, markets are rally. We rally to sell them, people, and we sell them to buy them. That's how I make my money. When you want to buy it, I want out. Okay, that's how it usually works. Second piece of story that comes out of this. You look at a railroad and you're thinking, look at that chart. It's so sexy. There's no risk here. Okay, news up, people. There's risk in every single sector in the market. You got to walk away from this and stop watching that stupid friggin' screen. That S&P is the dumbest product ever. It's trying to convince you that there's no risk at all in that product or anything built around it. Let's just keep buying NVIDIA and Palantir. People, there's risk in every product. And by the time you find out, you're probably going to get crushed on that trade. I keep telling you, When something is up, either you hedge it or you get out of it. That's how I make my living. I never sit around, because if I played this in the Genesis cog, my members deserve to fire me and take back their membership. They should fire me. There's no excuse for giving back a gain like that. None. I advise you, when you have a gain like that on any stock, especially a railroad, technology, take the money and run. This business is for you to book gains and walk away, not give them back. The third thing that you learn about this is that it makes you think like, well, how does the market buy? Did the market price this because of Buffett buying it? Or did they price it based upon actual fundamentals, mutually exclusive, independent of Buffett? What if we took Buffett out of the equation? Would you have still bought it up here? It makes me think like the market can't think for itself. It needs Warren Buffett to tell you how to trade. That's how sad and pathetic money managers have become nowadays. They trade off of charts and narrative instead of doing research. The stock is not bubblicious expensive, but at 19 times earnings for a stock growing at 10%, it's not cheap. If it gets down to a 15 multiple, I'm interested. But it was sitting at a 23 multiple, and for a railroad company, that's expensive. The fourth thing you're going to learn about this is this: if this railroad is falling out of bed, who's next? Is it FedEx? Is it DHL? Is it C.H. Robinson Worldwide? Is it UPS? Is the economy at the end of a rope? This is a transportation stock. If the transportation stocks are not doing well, neither is the economy, people, and that's a fact. Forget the utilities, forget the Dow. Those are a waste. Watch transportation. If transportation's strong, the market's usually running. And when transportation's weak, it's signaling we're heading for a corrective consolidation or a slowdown in the economy. This is telling me the economy's on borrowed time, irrespective of the Buffett news. Now, let me dial you in and let's do, wow, my short trades are kicking in today and my long trades just suck, but that's okay. My big short trade, and I'm not going to cover it today, but eventually it's going to blow up. I don't worry about it. But we're going to talk about Genesis cog, and then we're going to move to, okay, we're going to move to talk about what's called the hard hurdle. So you can understand this, because the hard hurdle tells me at some point the market's going to blow up, and I'll prove it to you. We'll talk about the S&P in just a second. I want to talk about individual trades. So for me, the most important thing in the Genesis cog, number one, is the algorithmic channel. Once the algo channel breaks, the trade is over. It's a fact. It's almost literally 100% done deal. See how the algo channel broke on CSX? Look for yourself. Okay? I rest my case, people. The trade is over. If you didn't sell right at 35, okay, you're now down about 15%. You screwed yourself. Anytime a trade looks like that, where an algorithm breaks the channel, I automatically have to consider hedging or taking off half immediately. Because once it changes, well, then the algos then start to set up and they start to walk it lower. And this is on a very sharp slope. I wouldn't buy this with your money. It's not even my money. I wouldn't even waste my time. We never buy into a downtrend. We never short into an uptrend. That's why we never get burned. Never. You don't trade against the algos. But I will tell you this about the S&P. I don't know when it's going to break, and neither do you. There ain't a person in the world, nobody at Theo knows squat. Every one of us will walk up and say, what do you think of the S&P? And Don and I will say the same thing. We don't know nothing. The path to enlightenment, according to the Buddha, and by the way, when I was in Kyoto in Japan, I went to the largest Buddha temple in the world. The Buddha did a pilgrimage all the way from India, ended up in Kyoto. I went to the largest Buddha shrine in the world. I have killer pictures. I'm going to get them eventually developed and framed. Amazing stuff. Okay. The Buddha, one of the things the Buddha says is the path to enlightenment is admitting you know nothing. So when I look at this, I don't know anything, but I do know one thing. Okay. It's near a high. And when it's near a high, I got to ask myself, how much downside is there versus upside? To me, the downside is deafening. It is lethal. It is going to happen eventually. And when it happens, a lot of people are going to get very badly burned. You're probably going to give back most of your gains for the last year. Most of you will. I don't know when this is going to break. It's in an algorithmic channel. You can see it right there. If it takes out 63 and a quarter, I think all hell's going to break loose, and I'll validate it with my ancillary indicators. But what's more important than that daily chart More important is what's called muscle memory. It's algorithmic muscle memory. Algorithms overlay many time frames. They look at things on an hourly basis, a daily basis, and a weekly basis. So if you want to follow my logic and change this to a weekly look, here is what you're going to see. I'm going to change this to a 1-year weekly look. Now, bear with me, okay? Bear with me, because I'm not trying to be the bearer of bad news. I'm not trying to be a Debbie Downer, okay? This is a very bullish chart. It's very hard to short. But this is the algorithmic channel, and I'll right-click and extend to the left, okay? This is what you're seeing. Now, you don't run the market. I don't run the market. Algos run the market on a day-to-day, minute-by-minute, second-by-second basis. So when you're looking at something like this, you have to come to like some type of understanding of what you're dealing with, okay? This is an algorithmic channel. It hasn't broken the channel, but I can tell you this. Zoom in and start to see. I'll have to zoom back out again, okay? You've got to focus on this weekly indicator. It's flat, flat. Algos trade off of slopes. It's a fact. I know it for a fact. I talk to people who program these things. It's the slope that matters most. The flat slope is not bearish. It's not bearish. But it's not momentum wildly bullish either. So if you're waiting around here telling me it's going to rally higher, it can. But not in this type of setup, it won't. You're basically banging your head against 6,500 over and over and over again. And as the channel gets more compressed and tighter, and the vol compresses, the vol is eventually going to have what's called an exhale day. It's going to exhale. And when it exhales, one of two things is going to happen. Either that sucker is going to pop on a gamma squeeze, or that thing's going to fall down to earth like a thud and crash 1,000. One or the other. All you got to do is plot the lower channel, just down here. There's one there, and there's one there. That's your first line of defense. That's your second line of defense. If you take out that and you're long this product, okay, you're going to need a therapist. You're not going to survive this because we're looking at 6,100 all the way down to probably 800 points. Can you sustain an 800-point loss in this product? I doubt it, unless you're short or unless you're hedged. The key to this model is if number one of two things has to happen. Either that MACD is going to break underneath that signal line there, or that RSI is going to take out 50. When that happens, you're not going to get any traction on this product for a long time, for a while, because you're so overbought and so many people own it up here. The overhead supply up here is too much to overcome. You're not going to overcome it. So I'm warning you right now, like, to buy here is absolutely lethal. To short, you're early. You're early. I wouldn't short it just yet. I would never buy it. But if it can break underneath that algo channel right there and underneath there, I would load the boat short and watch this thing completely implode, okay? Because the weekly indicator is virtually impossible to overcome. It's just impossible. Overbought means buy more to an algo. So you can see the algos continually buy the dips with the retail traders and the calls and jam this and keep it up here. It's like a floating balloon, but it's got like a glass ceiling. So that's my take on the S&P. Now, here are the trades that I'm in. Let's talk about one of my long trades. It's not sexy. I don't expect it to go up 90,000 points like Palantir, but we just took a position in this at around 39.70 to 40. Okay. Why? Number one is if interest rates are going to come down, and I expect them to come down at some point once, not 2 or 3 times between now and December, that expands. That will cut the cap rate, which will expand the value of this. This is what Garrett calls something you drop on your foot and it hurts. You drop it on your foot like, ouch, that hurts. Yes, when you drop it on your foot and it hurts, that's what an asset commodity is. And this is what this is. So we stepped in, we follow the Genesis logic. The Genesis logic is you never buy into a downtrend, ever. That's a downtrend. So you cannot, period. You can't even buy one of these days. It will not work. Buy there, lose money. Buy there, lose money. People, I don't think I'm right. I know I'm right. You just keep buying. You'll just keep losing money. You have to break the algo channel. If you don't break the descending channel, you keep just buried lower and lower and lower. We don't buy out. We buy, we do the Gianni DiPoci. Buy on the breakout. Once you break out, algos swarm like sharks. So we started buying on the breakout right over here, right on that breakout right there. Okay, it ran to 41.50. Now it's in a consolidation phase. I'm buying with a bullish divergence here. Got the bullish divergence on the RSI. I'm just trading with the RSI. So I'm trading with strength. So I'm trading with the algos. If it gets above that zero line, that could break that thing and run free to 43, 44, which would put me up 10% in a short period of time. And I'm also trading with the stochastic, because when it's more to the overbought above 50, you get buyers. I'm also hunting and pecking to grab that dividend if I can hold it long enough. There's my hedge. So if things hit the fan, I'll get that 52 cents. I'll be blocked at 39 and I'll break even. That's how it works. If it runs, it's like I'm just printing money like an ATM machine. If it doesn't run, I'm hedged because I'm buying it so low that the downside's mitigated, plus I'm defended by the dividend. The valuation of the stock is not 24 times earnings. You have to do the numbers. It's not quite correct. It's more or less about 19 times earnings. It's not the cheapest stock in the world. However, given the stock's consistency, okay, and the fact that it virtually never misses in earnings, I can tolerate a 20 times earning stock. Above 25, I can't do it, okay? Look at the weekly. Notice how the weekly is gaining traction. If that weekly gets above the zero line, that's nothing but air. That thing is just going to run. So what I'm doing is I'm positioning myself for what could be a run into the mid 40s, mid 50s. It's a storage REIT. The company has already blessed their estimates. They have keep raising the dividend a penny or two a year. I'm buying consistent cash flow. I'm buying a hard asset. It's a low risk, high return trade. Now you're going to look at this and say, well, what if it only goes to 44? Then I make 15%. How many of you would like to make 15% for the entire year? That would double the S&P, people. That's what I shoot for. So I took a position, about 300 shares of this at around 39.50 to 40. I'm not only up a buck. I don't care. I got all the time in the world. Stock ran about 30 or 40 cents today. That stock is not going to go up unless the S&P corrects. If that S&P corrects, that stock's going vertical because it's a defensive play. It's a defensive play in a slowing economy. The market will move towards, okay, all these money managers will gravitate away from tech. They'll gravitate away from cyclicals. And in the slowing economy, they'll move toward pharma. They'll move toward defensive retail. They'll move toward REITs. They'll move toward utilities, and they'll move toward energy. That's a fact. They're going to look for the yield, and I'm a little bit ahead of the curve. So for me, I'm good to go. This is one of my trades I took recently. You're like, but you're only up a buck. That's all I need. If it moves a buck a month, that's fine with me. Low risk, high return trade. That's what we look for in the Genesis cog. Okay, and I bought it at the perfect spot. Literally, my risk is down to 39.38. Oh my God, I could lose $2 to make 10. That's how you get it, become a millionaire in the business. You buy it when nobody wants it, but you have to have the technicals aligned and you have to have a good reason to buy it. So I bought a little bit of Cube. We'll see how it plays out. Now, as far as my short trades are concerned, one of my short trades at this point, I've got quite a few on. I have way more short than long. I'm short Cisco Systems. Now you're going to look at me and say, well, why the hell would he do Cisco Systems? Okay. First off, I'm short at the stock at around that 69.70 level. I also want to point out that I'm short the option. So when you come into my world, you don't have to be short the stock. I make more money shorting options than I do shorting stocks by literally a 5-to-1 ratio. Way more. Most of what I shorted Budweiser, Coke, and people but they only went down $2. My returns were 100%. All they had to do was expire outside the lower strike, and all of my trades did that. Monster, Budweiser, Unilever, all of them did. Okay, and the most recent one that I got out of was I actually got out of Micron Technology in time, MU. Okay, I got out in time way over here. So don't tell me you're only up about $6. I got 100% return because I sold the call spreads. I notoriously sell call spreads all the time. So I'm short shares of Cisco Systems, and I know it was a little bit of an upgrade today. That doesn't discourage me. Cisco is a stock that trades at a ridiculous valuation. It's just ridiculous. It's just stupid. They virtually have no growth. They need to trade way underneath a 15 multiple. So for me, shorting it's a value issue. But one of the reasons why I went into short Cisco around that 70 level is because Cisco broke underneath the Genesis Cog channel. Whoops, there it is. That's how we do it. You see that? I don't short on the way up. That's a fool's paradise. You're not going to make money. So I'm going to short there. How's that working? I'm going to short there. How's that working? The more you short on the way up, it's like throwing gasoline or a cigarette on a bonfire. You're going to keep losing money. You have to wait till it breaks, because once it breaks, the algos shift. They shift their models. All of a sudden, bam. When it broke right there, Genesis Cog's like, we're on this. Got short. Shorted the stock, dropped $2, covered 100. But I shorted 2 call spreads. I'm still in those call spreads, still in them. But you're starting to see like how this is playing out. Now look what you're seeing here. It came down. It bounced off that 67 level. Now you're thinking to yourself, well, that's going to go back up. How is it going to go back up when it broke? Once it breaks, as it rallies, all the overhead supply is going to be chipped away. Here is what I'm seeing. And this is just me being Brandon Chapman and Blake Young put together. This is me putting Brandon and Blake together in one full shot, because I listen to the guys all the time. That's a shoulder. That's a head. And over here, I'm waiting for the other shoulder on Cisco. Now remember, I'm sitting on a 68.70. All that matters is, and I've got about 2.5 weeks, this only one thing matters. It just has to be at the 68 strike or under in the next 2.5 weeks. Oh, be still my heart. You think I'm stressed? I laugh every day. Could it go up? Sure, why not? Sure, why not? But for me, it's like the risk reward is so good that the people who bought it there are sitting there going, man, if this could get to 69, I'm out. Yeah, they want out of this. That is a broken momentum. It's not a broken trend, but it's a broken momentum. All I need is for this stock to roll itself over, break underneath 66.74, and that stock will probably be at 63 within no time at all. For me, it's not about it going to 63. That's where a lot of you are wrong. A lot of you are like, he's got to make $8. I'm going to make 100% of my option. Okay, I sold the damn thing for 95 cents, that $2 wide spread. All it's got to do is not be above 68 in 2.5 weeks. So if it goes to 63 or 66, I don't even care. Be anywhere you want to be. Just don't go above 68. So most of what I do with the Genesis Cog when I short is not short the stock. It's short the option. Short the option. Because I'm just letting theta decay do its dirty work. All I care is just don't go up. Just don't go up. That's it. If it doesn't go up, I make money. That's the key to the Genesis Cog. Just don't go up. Didn't go sideways. But I'm burning theta. That's how I do it a lot of my short trades. Okay. Now, the other stock, and I took recently is Yum Brands. Yum Brands. And people like, why Yum Brands? Okay. I started getting short Yum Brands on an option, just one option spread. I'm short one option spread. One. Okay. Here's what I saw. And this one is already paying itself off in spades. This is why a lot of you should join the Genesis Cog, because a lot of you are obsessed with momentum. You have to get that. I will cure you. I'll fix you. I'll get momentum out of your head. Go to Gianni for momentum, but spread the wealth. Think to yourself, how do I make money? Okay. When momentum breaks, that's where I come in. That's my expertise is short selling. Of all the guys here, I'm probably the worst buyer, but I'm probably the best seller. A short seller, you can ask Garrett. My short sells usually work out really well. Here's where I shorted it, right there. This is a Genesis Cog. Okay, it's not an alert, but it's a Genesis Cog trade. Come on, baby. Look, I'm right there. Look here. Okay, once I saw it break right there, that was it for me. Okay, that is what's known as an engulfing, bearish engulfing. Take a look at it. It's a bearish engulfing trade. Look at it. Okay, it broke the upward momentum, broke it. And the reason why it broke it is because a report that came out that consumers are spending less time eating at fast food restaurants because the pricing structure doesn't work as well as they thought. They're spending more time buying groceries. As soon as I caught that, I'm like, man. So I took the trade right about there. I didn't quite get that 151, but I got that 149, 150 spread. Okay, I mean timing. I'm sitting on a 148 151. It's a $3 wide. I got about, I think it was like a $1.24 for it. So I had to give up an edge. I didn't quite get the $1.50, but I did get a delta about 0.42 at the time. Okay. How's that working out for me? Okay. This is the power of the Genesis cog. I find stuff in a split second. I see it. I track it. I have a scanner. It brings it to me. It tells me where's the break. It finds the break. I don't take every trade because of the break. There have to be other things that go into it. But what I saw in this one was a stock that went vertical, that trades at 28 times earnings. That's stupid. Totally stupid. That stock is never going to grow at 28% from now until the end of time. That stock should be trading below a 20 multiple, period. So I saw it. I got it. Okay. This is the 5th day in a row I'm making money on this. It's now in a downward algorithmic channel. Okay. My deal is I got to be out of this by the second. I have to. I have no choice. I am liable for that dividend. But in that short window, I was able to capture it at that 149 half level. I'm up $3. I will close that trade, but I've got another 4 or 5 days. I will see how it plays out. But if you're looking at this way it's looking, look at what's going my way. The strength is getting weaker. It's now broken below 50. That's bearish. The MACD hasn't even curled over yet. It's still hanging out by a thread here. And that worries me because a lot of people may dive in to buy this, right? To buy this ahead of that dividend. So I have to be Johnny on the spot between now and Friday, every second of the day. I've got to watch this because I got to take this out at some point and not be liable because it might drop down here. It could drop down here, but that dividend is going to force my hand to cover it. I've got everything going my way. But my point is, the Genesis cog works because the lowest risk short was right there, and I got it. You have to seek the lowest risk because if you're wrong, and you're gonna be wrong, it's inevitable. You have to mitigate the damage as much as possible. All it takes is one day of a screw up trade, and you're like, my account's 100,000. Oh my God, my account's at 80. If you're down $20,000, you're not coming back. It's over for you because it will take you years and months, decades to get it back. One bad day can wreck your account. I think about that every day. So all my trades are very conservative. They're risk in mind. Reward becomes a secondary afterthought. I got to make money, but I got to think to myself, what matters most is I get the risk down. The reward will come. That proves it right there. Just make sure that the risk reward is tilted in your favor. Most people like, I don't care about risk reward. That's until your account blows up, a massive amount. You're like, damn, I'm down 25%. At that point, it's too late. You're not recovering. You won't. But it will bounce. Bounce when? You're going to get a margin call. You can't let yourself have chunk losses. You have to have small losses and big gains. That's what Gianni does. That's why his returns are insane. He has massive gains and little losses. That's how you have to do it. Corey's the same way. Massive gains, little losses. That's how we operate here. Now, last thing, I want to go to the hurdle rate, but I'm also short this stock. Okay, this is another bubble I'm waiting to break. All I need on this one is, okay, and I started adding more. So Genesis Cog put this out again. I just got back into this trade at 42.50. I'm short again. Okay, all I need is for this to break underneath 41.45, and this is another home run trade. This is a bubble stock. The earnings were not very good. They were basically in line. The dividend's 28 cents. It's behind me. Again, a stock trading at 22 times earnings with zero growth. Zero. Their growth is declining. This is a sequential decline in earnings, and the stock went up. That's how you know money managers are just broke. They're mentally broken. The stock's earnings are declining, and you're buying it and raising the value. They're making less money, and they can't raise the dividend. That's a bubble, people. That's how it usually. This is how, like Don said, we're in a bubble of so many sorts. I can find 1,000 stocks where there are bubbles. This is one of them. So I'm short this stock. I'm letting it play out. All I need is a break below the 50. Okay, I started shorting over here, right there. See how it broke the Genesis Cog channel? Right there. Channel's broken, right there. That's where I got short. I always short right on the break. Only if the value hits and only if the story makes sense. Now, the last thing I want to throw out is this. I want to talk about just for a second called Death to Jargon. This was a segment created by Ross Bowring, my faithful marketing director. So I want to point this out. Death to Jargon is a segment where you hear a term and immediately you're turned off. Immediately you stop and go, that's scary. Hold me. I'm frightened. I can't take this. You're like, the word just frightens you. Okay. My job to walk in and to simplify. Take something, distill it so that a third grader could understand it. People, you've not heard this term, but you need to know what it is. It's called a hurdle rate. What's a hurdle rate? Okay. A hurdle rate, and I can't blow up this picture. I just can't do it. I've tried a million times to blow up the picture, and it just won't allow me to do it. So a hurdle rate, and I wanted to show it from this perspective, and I just can't seem to pull up that hurdle rate. I think I have to go backwards, and it's just too late at this point. But a hurdle rate is something whereby this, and I'll spell it out for you. There's a hard hurdle and there's a soft hurdle. A hard hurdle is where a money manager, it's not a mutual fund, not a bank or a broker. A hedge fund manager has a hard hurdle rate. A hard hurdle rate means you set a performance number based upon the return of a benchmark index, and you have to beat that number. So for instance, the average hard hurdle rate is 8%. The expectation is from now for the next 10 years, the hard hurdle rate is 8%. That's a fact, people. And it keys off of the S&P 500. What does that mean to you? It means money managers have to get better than 8% who are paid off the hard hurdle rate. A soft hurdle means they just have to show a profit. So let's say you give them 100,000. They make 110,000. So that $10,000 profit, they get a percentage or a piece of that $10,000 profit. And normally it's 20 to 30%. So on a soft hurdle rate, it tends to be 20%. You make 10,000, you put in $1 million, the manager makes 100,000. That manager then keeps 20,000 of that 100,000 profit. That's a soft hurdle rate. A hard hurdle is different. It means it's keying off the major benchmark, and the differential between the return of the manager and that benchmark is how much they get to keep. But if you key off a hard hurdle rate, there's a differential. Instead of getting paid 20% of profits, they tend to demand 33 to 40% of profits. So when you set the hard hurdle rate, it pressurizes the money manager to outperform the S&P. So normally, what are they going to do? Take massive risk. Do they care? No. Why? It's not their money. It's your money. So you give them $1 million and you say, I'm going to set the hard hurdle rate at 8%. That simply means you give a money manager $1 million. If they make, $200,000, the money doesn't matter. The hurdle rate matters. So for instance, if the hurdle rate's 8% and you give a money manager $1 million, that means that money manager's bottom number is 80,000. Aside from the management fees you pay them, that money manager has to make 80,000. If that money manager makes 80,000 or less, they get no bonus. Zero. They have to make a minimum of 80,000 and above. So if the hard hurdle rate's 8%, the money manager makes 20%, which is 200,000, then the money manager gets 40% of the differential between the hurdle rate and the profit, which is 100 and what? 120,000. 200,000 minus 80,000. 200 minus 80 is 120. They will get 1/3 of that 120,000. They will debit it from your account. Why do I bring this out? Because right now, the hard hurdle rate is sitting at 8%, and the S&P for the year is up about what, people? Look at it yourself. It's a critical juncture point in the S&P. Critical juncture point. Here, I'll show you. Time frame, year to date. Did any of you see this? Because if you're not looking at this, you better start paying attention. Look at the percentage of the S&P right now for the year. Look. The S&P right now for the year is up 7.5%. The hard hurdle rate is 8%. What does that mean? It means if the S&P ends the year right now, right here, most money managers in America who run hedge funds get no bonus. Nada! You get nothing. All you get is the management fee, which is still about 2% of the total amount, but they don't get any part. So you can see what they're thinking. They're thinking, holy crap, if we don't jam this thing higher and get this above the hard hurdle rate of 8%, we're going to get nothing. That's why the market's rigged. It's up every day because these hedge funds know that they've got to pressurize this and get this to 7,000. That's why they're doing this. If we turn over and roll over, that means literally every money manager in America gets no bonus this year. It'll be the first time in 4 years they get nothing. So you're at a critical juncture point between the hard hurdle rate of getting a lot of money for your performance bonus and nothing at all. It's right there right now. And I'm telling you, if NVIDIA doesn't deliver and we break down, that means most of your money managers are going to run amok and go, screw it. They're going to start buying crazy, wacky stocks just to get the number up to beat the hard hurdle rate. If you don't know about hard hurdle rates, you better learn about them because they drive the greed and the momentum factor behind money managers. It's a fact. That's why I brought this up to educate you. People, things are never what they seem on Wall Street. A lot of things are behind the scenes hidden from you because if you knew what they were doing, you'd never give them a dime of your money. They're doing things to elevate so that they can feather their own bed, their nest, and get rich, not necessarily yours. Be aware of that. On that note, Brandon Chapman is going to spell me today. I am going to walk away today and do the Genesis cog. I've got 30 minutes to dial in there. In the meantime, Brandon Chapman, please show your face so I can let you take over.
You just want to look at me, don't you?
Well, you're a lot better looking at me. The only thing is I'm not as gray as you, but the way I'm raising my daughter and her, she's like Lisa Simpson. She's very precocious and cynical. I'm like turning gray faster every single day. How many kids you got,
Well,
Brandon?
I got
15?
you beat in the gray department.
You what?
I got you beat in the gray department.
Well, that's because you have 5 kids.
That's true.
I've got one that I'm stressing on already. So,
yeah.
But anyways, Brandon, I'll let you run with this. Brandon, to me, the market's in a pause mode. It's just we're in a pause mode. It's NVIDIA or bust. It's all about NVIDIA, Brandon. That's going to make or break the mark tomorrow. What do you think?
I don't know. I mean, like I said, we just keep seeing that, the concern of the downside risks are just keep elevating. They just keep getting higher, and it's like, is it going to be realized? I mean, we can't predict perfectly what the market's going to do. It's just, how do you handle, if you have these institutions, they're pricing in significant downside risks. What do? Do you just sit back and blindly buy, or do you just take a step back and be more measured?
Brandon, I'll tell you right now, I'm loading the boat on my short trade. I'm literally skewed 2 short trades for every 1 long. I'm starting to move from 8 to 2 to 1 long short to 2 to 1 short long every day as time goes by that we flatten out here. I'm not betting on this market going higher, even with the rate cut. Not at all. I'm not doing it.
And whether we actually drop or not, I mean, the results, I mean, the way that the market's pricing in volatility, they're pricing in that the downside's a lot bigger than the upside. So if you take those bets and you control your risk, I mean, if you load the boat on the downside, again, at least you're getting out with small losses, but you could catch a windfall if the market really sells off here.
Absolutely. The risk reward is the best I've seen in probably a decade, literally.
I mean, it definitely looks that way.
Yeah. So at any rate, I'm going to jump out of here and let you run with this. I've got to do a Genesis cog. Have a great day. Run with your thesis. Go for it.
All right. Thanks, Press. We'll see you. All right. So if anyone wants to make themselves known in chat,